starting with Alphabet and Microsoft tomorrow after the bell. So let's bring in RBC Capital Markets analyst Brad Erickson to talk about what he's watching. Brad, my initial question has to do with the cloud hyperscalers, Microsoft, Amazon, Alphabet, maybe particularly Amazon Alphabet for you. How much of this is going to be about top-line growth in cloud, which we know is being pressured by customers who want to save money?
Yeah, that is absolutely going to be the issue, and not really on Q1 so much, but more on Q2, where I think investors are actually thinking AWS growth in particular could dip as low as maybe 10%, which is kind of an unprecedented low in the history of that business. Yeah, pretty low. And so as they sort of work through that and message that, what people are really looking for is, if that is the trough, that's actually going to be good enough, we think, on the quarter. You will have some margin pressure around that, but I think people are looking for that reacceleration into the back half of the year, and that's where I think a lot of folks are feeling like Amazon actually sets up quite favorably into the print.
So it wouldn't be a situation where you're seeing Amazon cede market share to some of these other companies. It would be a situation where it's really just other companies tightening their belts? I
wouldn't characterize it as so much ceding share. That sounds more defensive. I think what's going on actually is that they are reaching out to their customers more proactively to optimize, but in doing so, they're actually early renewing people, and so they're actually locking up share for longer, signing longer duration deals. There is a margin hit associated with that, and in a consumption type business like that, their customers are consuming less, i.e. they're growing slower. But I think when you think about the longer term, which is obviously always the game that Amazon tries to play, I think they're actually doing something that's sort of underappreciated and more proactively positive, I would say, longer term.
Now, Brad, tell me about Meta. What's more important to investors in this quarter? More cost reduction color? We already know it's the year of efficiency, or monetizing Reels? Because I'm starting to see ads show up where they weren't there. So maybe they've got some color on how well they're monetizing. Yeah,
I think the year of efficiency narrative is pretty well known now. I think my mom's actually aware of that one by now. So it's a top line story from here. You need reacceleration. Everyone knows that Q1 was a tough quarter. I think you're looking for pretty modest acceleration in Q2, call it 100, 200 basis points. I think what bulls are pointing towards is getting back to a double-digit type growth rate entering 2024. If you can do that, I think the stock's still trading well below a market multiple, and I think people think it continue to work. But you need a top-line story from here.
Okay. And the fact that we do get Alphabet after the bell, and we keep talking about these emerging AI wars, is that what matters, or is it something else?
You know, everybody always evaluates the core business, which is the search business. And actually, our checks have been quite positive exiting the quarter, even more so relative to Meta. So it's actually kind of our preferred name heading into earnings. But absolutely, generative AI is going to be the topic du jour on the call tomorrow afternoon. They're going to need to talk to CapEx and the implied compute costs and the intensity there, as well as some of these latest controversies around how do they keep their search engine at the forefront? How do they keep Apple and Samsung from considering other default search providers? So yeah, management has a lot of, I don't want to call it explaining, but they have to look to control that narrative on the conference call tomorrow afternoon.
Okay, we're going to be watching closely. Brad Erickson, thanks for teeing us up there with outperform ratings on Amazon, Google, and Meta.